Friends, today I would like to bring an update on some stocks that have an increase in shareholding of the mutual funds. So there are about seven different companies that have increased their stake, or mutual funds have increased stake in seven companies, which are as follows. One is Max Financial Services Limited. The other one is Airtel Limited, formerly known as Zomato. Then Taj GVK Hotel and Resorts Limited. Then the fourth one is Home First Finance Company. Fifth one is GAIL India. Sixth one is HDFC Bank. Seventh is Granules India Limited. So these are the details we'll go through. You can go through the write up as well. However, we'll go through the details uh, one by one. Okay, we'll. All right, here we go. Okay, this is the first one. This is Max Financial Services. Current price is 1,163. It's about 11% up in the past 1 month. Overall, a negative return of 1.68 in the last 6 months. However, overall on the upside in the last 1 year, the stock is almost up by 14%, which is a good indication of how well the company has managed to keep itself aside from the turbulent markets. So market cap of 40,000 crores, price to book value of 6, face value 2, book value 195. I think some of the net profit and stuff like that may not be most up to date. However, promoter holding, which is only 1.74%, something to keep in mind. These are the comparatives of the peers in the industry. Numa Wealth, Anand Rathi Wealth, Prudent Corporate, Sera Investment and Finance, 360, One Warm, and BSC. So you can see the price of the different companies with the market cap. Max Financial has the second highest market cap. Then this is the logo of the company. Then high of 1,311, low of 864. Book value from another side shows as 150. Stock price to earnings is 159, which is very high. Return on capital is about 9.7%. So again, not that great, but considering the industry, uh, seems to be quite decent. The negatives mostly: stock is trading at 7.7 times, reporting profit, no dividend paid. Promoter holding has decreased 1.6% in the last 3 months. Promoter holding is low. Tax rate is low. Company has low return on equity, about 8.8% in the last 3 years. Promoters have pledged 28.7% of the holding. So when the promoter holding is only 1.7%, and on top of that, about 30% of their holding has already been pledged. So again, sentiment that doesn't work well for the company. But however, you can consider the other peers, different set of peers listed by a different website. You can see stock price PE is in the range of about, median shows 20 based on 195 companies. However, you can see the top 7 8 companies. The low PE is about 15 16, and an average PE is about 30 to 35. And you have Geo Financial, which is at 90. So something probably not making enough profits to justify the price. Then you can see these are the sales revenue for the company. So again, you can see it has gone up in June, September, then again December quarter. The revenue has come down. Operating profit was high, then it's come down again. It was at a negative in March 2024 quarter. Then you can see uh, the profit is also fluctuating. So for the price to gain momentum and gain a bullish run, it would need to give a good financial quarter result as well as good profit, and the overall expectation from the stock would be needs to be at a high expectation to do well. Then you have overall sales year to year. It is growing, no doubt. However, the net profit doesn't seem to be able to keep up with the previous year. So again, which will impact uh, the, the share price of the company. Then you can look at sales growth average of 14% in the last 3 years. Then profit growth minus 41 in the last 12 months, minus 7% in the last 3 years. So again, is a cause of concern. Not able to improve its performance, not able to grow its business. So that is the concern. Stock price overall 14% return in the last 1 year, and an average last 3 years also 14%. Return on equity has reduced from 10% to 9% in the last 3 years. You can see reserves are growing gradually and slowly. Uh, Liabilities have also increased. So overall, something that the company needs to keep a track of, keep a check on. FIs hold about 45% of the stake here, and direct institutional investors about 48%. So the price movement is restricted in this stock because of the high holdings of both foreign institutional investors and direct institutional investors. So both of them control a large pie. So there is a possibility of stock fluctuation when the FIs or DIs try to sell their stock holdings. It will accordingly impact the overall share price of this company. So if the two DIs and FIs stay put, then it really won't affect the overall price or the valuation of the stock. There will be low volatility. So moving on, Eternal Limited, uh, 2.3% up in the last 1 week, 5% in the last 1 month, negative of 23 in the last 6 months, and overall 14% positive in the last 1 year. This is the symbol of the company. The market cap of 2,09,000 crores, debt is zero, cash 459 crores, earnings per share 1.85 in the last 12 months, sales growth 40%, return on capital employed 6.38%, price to earnings value of 118, which is very high, book value is 35 rupees, price to book value 6.31. Then these are the comparisons with Swiggy and some other small companies. This again, public holding is 32%. DIIs have a lower uh, shareholding value than FI is 44%. Again, here the volatility in the stock of the price would be based on uh, as and when the FIs or DIs sell their stake. Yeah, public holding is 32%, which could cause volatility in the stock. Company has shown good profit growth, that 52% in the last 3 years, revenue growth of 57% 3 years, debt-free, healthy interest coverage ratio, poor return on equity in the past 3 years, poor return on capital, tax rate is very low. Company has a low EBITDA margin of 33%, minus 33%. Company is trading at a high of 118. These are the negatives. Then company's PEG ratio is 0.11. Company has efficient cash conversion cycle of 3.61 days. Healthy liquidity position of 2.4. Current ratio has strong degree of operating leverage. So high of 305, low of 146. Book value 22. So this is like the most up to date information compared to the other site. You can see return on capital is 1.14%, and again the cause of concern. Novel companies' working capital requirements have reduced from 191 to 46 days, which is a positive. Companies trading 10 times its book value, minus 4.8% in the last 3 years. Earnings include another income of 944 crores. So again, this is something that needs more analysis and could dampen the sentiment of the company. Another comparison, Info Edge, India, Eternal Limited, Swiggy, 197 in India Mart. These are the comparisons in price and the price to earnings value. Then sales have been growing, which is a good sign. Operating profit has been on a bumpy ride. It has fallen in the last quarter, so that would have impacted the overall sentiment of this stock price. Lower operating profit and a lower net profit compared to the previous quarters. And you can look at the overall sales, they have been growing year on year. It's a good performance. However, the price to turn into a bullish trend and stay put would depend again entirely on how well the company performs on a quarter to quarter basis. They need to have a good increase in revenue, good increase in operating profit, good increase in net profit, and the operating margin needs to improve as well. So uh, that will ensure how the stock performs in the next 2 quarters. Again, these are some financials. Sales growth is good. Profit growth is what the company needs to look at. Reserves have increased, which is a good sign, however, not as much as expected. Then Taj GVK Hotels current price 426, 15% negative return in the 1 month. Past 6 months, 41%, which is excellent. The stock hasn't been impacted by the fluctuations in the stock price. Overall, company has made about 18% return in the last 1 year, though there are good chances that the company can improve its overall uh, share price and the performance. It could have fluctuated because of a quarter not giving the good results, but we'll have a look. This is the logo of the company. Ownership strength is slightly missing the benchmark. Stock is at a premium valuation at this point. Company possesses stable growth history and manageable debt. Company could improve upon its asset employment. So again, better use of resources, which would lead to better revenue. Market cap 2,677 crores, book value 96, cash 73 crores, debt 64 crores, promoter holding 75%, earnings per share 12 months 15, which is good. And brands of the hotel or the company: Vivanta by Taj, Taj Banjara, Taj Krishna, Taj Deccan, Taj Chandigarh, Taj Santa Cruz, Taj Clubhouse. In some companies comparison, I can see the most companies hold market cap of between 1,000 to 6,000 crores. Then price, apart from Banaras hotels, most companies trade between 100 rupees and 600 rupees, which again is very affordable for you to own a stock in comparative industries also. Then promoter holding is 75%, public holding 20%, DII is 4%, FII is 1.75%. So again, the stock will have some volatility because of 20% public holding. However, based on how the company has been performing, it doesn't seem that the company would lose value. And since the mutual funds have increased their shareholding recently, I would believe that this company would provide a good and long-term stable return. in the value of the stock. The company has good profit growth of 69% in the last 3 years. Company has shown good revenue growth of 63% in the last 3 years. Company has decreased its debt by 32 crores, which is a very good sign. The company has been maintaining a healthy effective operating margin of 21% in the last 5 years, which is amazing. Company has a good interest coverage ratio of 9. Company has efficient cash conversion cycle of 710 days. So a lot of advanced bookings made on the company's side, which could be the reason why the company is able to uh, have a negative cash conversion cycle, which again is a very good sign for the company. Here, high of 528, low of 275, stock P about 29, book value 90, return on capital 18, which is good. Return on equity about 15, face value 2 rupees, reduced debt, good profit growth 25%, low return on equity compared to other companies, Lemon Tree, Mahindra Holiday, Taj. As you can see, the median is based on 44 companies, so we'll still just go by the top 7 to 10 companies. You can see some of them have a very high PE. That means those hotels are not able to generate sufficient amount of profit against the price that they trade at. So you can ignore Venative, Charlotte hotels. You can look at ITC. You can look at Indian hotels. Again, Indian hotels is at a very high PE of 72. So Lemon Tree, Mahindra Holiday, and Taj GVK hotels, the three companies you can analyze and consult a financial stockbroker if you need to invest in this company or for a long term view or compare with these companies. Then sales have been a little bit erratic, however, overall improved in the last quarter. Operating margin has improved. Net profit again has improved, which is a good sign. However, for the company to continue to do well, it would need to maintain the current uh, driver growth, increase of revenue, increase of operating profit, increase of operating profit margin, and net profit needs to increase at the same time as well. Then overall sales year on year, they are doing well. The last 12 months may not be as good as the expected sentiment of the market, however, still is able to deliver a higher profit margin, a higher sales revenue, uh, higher operating profit margin as well. So overall, the main points to consider here would be revenue, operating profit, operating margin, tax, profit before tax, and net profit after tax. So those 4 points would drive a bullish growth based on the company once it is able to keep a track of this and improve its overall performance. Then sales growth 11% last 12 months, profit growth 46% in the last 12 months, CAGR again stock price 18%, which is very good. Overall last 5 years 30%. So companies consistently giving good stock price 30%. Maybe there would be a slight correction. We could expect at least a minimum of 15% in the next 12 months based on the company's performance. It may not grow as what we have seen in the past because the stock market is at a high, at a very peak level already, and there are chances of growth not meeting up to the expectations of the market. So for the company to do better and provide a high return on the price, it would need to double its revenue, double its profit. Operating margin would need to improve, and then value addition in form of reserves would be something that would we need to be looked into once the company needs to achieve price momentum again. Reserves gradually increasing, borrowings have reduced, which is a good sign. Liabilities have grown. Company would need to keep a check on those liabilities. Overall, debtor days have improved, which is a good sign. Inventory days have reduced as well. Days payable have increased again. So again, something for the company to look into. Working capital days have you know can be managed better. Return on capital employed has reduced but has improved over the comparative last 4 5 years, which is a good sign. Then we look at the next company here, that is homebuyers finance company. Current price of 1060, 6% addition in the last 1 month, then minus 12% in the last 6 months, 18% in the last 1 year, which is a good sign. This is the logo of the company. Stock price may face volatility due to ownership structure. Stock is at a premium valuation at this point. The company could improve upon its asset employment so it could better use its assets. Company possesses stable growth history and sound margins. Stock PE of 30, operating revenue 1,137 crores, book value 265 crores. Motor holding is 14%, TTM is 12 months, CPS 35, sales growth 43, return on equity 16%. So companies to compare, a huge list. You can have a look at how much is the what matters is ROC and return on equity. So companies giving a higher return of above 12 13 would be something that the company could look at. So at the end of the day, ROC for most companies below 10, which again doesn't seem to be very great. However, that is the industry standard because it's a finance company. Then promoters 15%. So the major chunk of holding is FIIs and DIIs, providing some stability to the stock. However, 30% shareholding of the public is going to make the stock volatility high, as suggested by the company. The ownership structure is what determines the volatility of the stock. A high of 1,383, low of 777, stock PE shows 26, book value 255, ROC E11, face value 2, stock price is trading at a high, low interest coverage ratio, promoter holding is low, company might be capitalizing its cost, promoter holding is decreased, well, median sales is 10.53% in the last 10 years, working capital requirements have reduced to 15 days. Company has delivered good profit growth of 46%. Some other company comparisons, Bajaj Housing, Hupco, LIC, PNB, some of the same companies we've just had a look. Price to earnings, again you can look, see LIC Housing 6, which is probably the best possible you can get at this. LIC Housing is something that can be looked into. Consult a financial stockbroker if you're interested in uh, pursuing investments in this particular field or sector. Then revenue has been improving, which is a good sign. Overall, net profit remains to grow at a very small pace. So, single digit growth for the company to start performing well. A double-digit growth and improvement in the financing margin would be something that the company would be able to achieve better returns. This is year-on-year comparison. You can see the last 3 years, the company has more than doubled its revenue, and it's almost going to triple it. At least it'll reach 2.5 in the next few, maybe in the next 1 quarter. Again, TTM sales growth 36, stock price growth of 18%, which is so far the best in the company's history. So profit growth 26% in the last 1 year, which again is a very good return. Reserves increasing, which is a good sign. Promoter holding, we've gone through this. Then the next one is GAIL India, 2% up, 10% up in the last 1 month, minus 26%, a negative of 26% in the last 6 months. Overall, last 1 year, a negative of 16%. So, this may be a concern. It could be performance related, and maybe the stock would have been overpriced or overvalued, which is the reason why there has been a correction in the last 1 year. So, this is the logo of the company. Ownership strength is slightly missing the benchmark. Stock is at a premium valuation. Company possesses stable growth and manageable debt, which is very good. Company could improve its asset employment. Some values again, debt of 16,000 crores, which is a big chunk. Book value 113, P of 10, price to book value of 1.52, which again is pretty good, not very expensive compared to the price 170 price, and the book value is about 113. Though the only concern is the high debt, and the sales hasn't been growing. We'll have to look at the other financials comparative, uh, industry wise. ROC again 15 is like the base, and you have companies giving you high returns as well, so something that can be considered, and some analysis could be done into the other companies. Promoters 52%, DIs and FIs hold about 40%, so again a big chunk held by the others. I mean, mostly by the DIs and FIs. That is what is the positive about it. The volatility of the stock would be low because public holding is about 7%. High of 246, low of 151, stock P about 11, book value 127, ROE 14, again good. Other income of 5,190 crores, again this is something that would be something that we need to look into, that could possibly drive a negative sentiment towards the immediate stock price of the company. Dividend growth, uh, dividend yield of 3.8%, maintaining a healthy dividend payout of 44%. Some comparisons to the other industry: gas operating profit is reduced in the last quarter. Overall net profit has increased, which is a good sign. Revenue increased, operating profit reduced. However, net profit still the best in the last maybe 1 year. So again, very good for the company. I think has corrected itself from the past performance, which is the reason why it has able to generate a good return. Again, you can see year on year the net profit has been increasing, which again gives a good signal of consistent growth and performance. Again, sales growth has reduced, however, the operating margin has improved, which is good. Reserves have increased again, which is a good sign. Is increasing every year, which is a good sign. Again, this is inventory days have increased, days payable have increased, so something for the company to look at. HDFC Bank, which is one of the best performing stocks, you can see that the company is doing very well. Good value addition, good return. Overall, 21% in the last 1 year, which is a good sign. The HDFC Bank is a logo, very good value addition, so something that you can uh, not really worry too much about. This is, you can see overall public 16%, FIS, DI is the biggest chunk, so there would be less stock volatility here, and improvement in the performance is likely based on the ownership structure. Consistency is the key. Return on assets of 2% in the last 3 years. Good return on equity. NPA is 0.31% in the last 3 years. Some other value addeds you can possibly get a stockbroker for suggestion on what needs to be done here. Stock value 652, book value. Uh, Again, most of this seems to be very good. Yeah, contingent liabilities, which is the possible concern. Comparisons to other companies, again, you can see 21, 19, 20. So some company, other companies you can consider based on their price to earnings ratio. You can see Axis Bank, IDBI, IndusInd Bank, Yes Bank. You can see revenue more or less consistent. Mm, yeah, profit hasn't grown as expected. However, broader trend would be that the company is able to uh, give a good consistent performance based on the industry that it is in. This is the overall picture for the last 3 years, you can say. And good profit growth in the last 1 year or 2 years. Again, the average is about return on equity consistent in the last 10 years. Stock price 21%, which is amazing. In the last 1 year, it has done an amazing job. Profit growth 18%, which is reduced compared to the previous 3 to 5 years. Then sales growth has been good, 31% in the last 1 year, 30% in the last 3 years. Reserves amazing again. Good value stock to have in your portfolio. Then this is already something that we've considered done gone through. This is the last company, which is Granules India. Current price 451, 11,000, market cap high of 703. Dividend payout has been low of 8.34%. Promoter holding decreased by 3% compared to the other companies. So is in the pharma space. You can see the other pharma companies. I'm sure there is no comparison to the other companies that it performs. Ideally, we'll have to look at the bigger, broader segments of pharma that the company operates in. So again, these are some values. You can see that the net profit has been fluctuating. So is the operating profit margin also has been fluctuating. Sales have also been consistent. One quarter there was a reduction, so the bullish trend or the growth trend is missing here. The company would need to grow its revenue, operating margin, operating profit margin percentage, then the net profit. Only then would you be able to see a big trend in the stock. So just something that you can look into. Overall net profit hasn't been what it was in the past, so something that will affect the stock price. So that's all for today, friends. You can keep a track of these companies, consulting, broker. Some of the stocks have a very good value, and some could, be a good value addition again to your portfolio. So consult a broker, seek which one is the best for you to invest. Some of the companies have a very low volatility, stock volatility in terms of volume sales, which would be a positive point for you all to keep this as a part of your holding. So thank you for watching. Please share this with your friends, family, and associates, those who would be interested in keeping a track of these stocks. Thank you.